Hi, this is Dr.S.VALLUVAN from MBA. Now we move to the next topic called top down and bottom up approach in fundamental analysis. Let's look at the difference between the top down and bottom up approach. Top down and bottom up approaches are methods used to analyze and choose securities. However, the term also appear in many other areas of businesses. Finance, investing, and economics. While the two schemes are common terms, many investors get them confused or don't fully understand the difference between the approaches. Each approach can be quite simple. The top down approach goes from the general to the specific, and the bottom up approach begins at the specific and moves to the general. These methods are possible approaches for a wide range of endeavors such as goal settings, budgeting, and forecastings. In the financial world, analysts or whole companies may be asked with the focusing on one over the other. So, understanding the nuances of each is important. Top down usually encompasses vast universe of macro variables, while bottom is more narrowly focused. Top down investing strategies typically focus on exploiting opportunities that follow market cycles. Bottom up approach starts with the local or company specific variables and then expand outward. Fundamental analysis is an example of bottom up investment approach. While top down and bottom up are distinctly different, they are often used in conjunction with each other. Let's see one by one. First, top down approach. The top down approach, first a trader or investor analyzes the broader view of the economy, sector, and the stocks. Generally, the trader who wants to hold his trader for the short term goes up with the top down approach. Also, through this approach, the trader will first analyze the stock with higher time frames. Let's look at the top down approach in detail. The starting point, macro level economic environment. It starts with the macro level process. The analysis initiates with an assessment of broader economic factors such as overall economic conditions, industry trend, and market conditions. In this, the focus areas are economical conditions, industry trend, market conditions. Narrow focus. After evaluating these two macro factors, the investor narrowed down their focus to specific companies or assets that align with the identified economic and market trends. On the other hand, bottom up approach. A trader or investor focuses on a particular stock and not on a broader view of the economy or that a particular sector. In this approach, investor assume that the stock will perform better than the sector or an economy. Hence, he analyzes the financial of the company along with other technical indicators and takes his final decisions. In bottom up approach, starting point is micro level, that is individual companies. Process. The analysis begins with the detailed examination of individual companies or assets, independent of broader economic considerations. Focus areas, financial statements, scrutinizing the financial statements to assets, revenue, profit margins, debt level, and other financial metrics. And the competitive position, evaluating the company's market share, competitive advantages, and overall positions within the industry. Management quality, assessing the effectiveness and reliability of the company's leadership and management team. Broader considerations, once the specific companies are thoroughly analyzed, investors may then consider broader economic and market conditions to ensure their chosen investment align with the overall economic landscape. So these are the bottom up approach and top down approach. So bottom up investing, for example, a portfolio team may be tasked with the bottom-up investing approach within specified sector like technology. They are required to find the best investment using a fundamental approach that identify the companies with the best fundamental ratios or industry leading attributes. They would then investigate those stocks in regard to macro and global influences. Metric focused smart beta index funds are another example of bottom up investing. Thank you.